Hello friends, I welcome you all to Value Investing Secret channel. Today I am going to explain Avanti Feeds, which is in the business of quality prawns and fish feed and prawn exports. Let us go to Excel sheet. In the first method, I am going to evaluate using a revenue method. For this I calculated volume weighted average price per share, then I have taken the total number of shares from BSE website. Then we can calculate market capitalization, that is weighted VAP and multiplication with the total number of shares. You will get the market cap, that is in crores. Then I calculated TTM revenue, that is year on year. We need the total income from operations of last 3 quarters. It is September, June, March 20 and December 19. I got this value. Then we can calculate the revenue multiple, that I got 1.7. This can be calculated by using market capitalization divided by total income from operations. I'll get the revenue multiple. Then I have calculated revenue growth. For this we need revenue from operations, that is year on year. This data we can get from annual report of any company. So I have downloaded the annual report of Avanti Feeds. If you download the March 18 and March 20 annual report, we'll get the March 17 and March 19. You can see here I have downloaded 2 annual reports, that is 2020 and 2018. Here we have to check consolidated statement of profit and loss. So revenue from operations, which is highlighted, that is in lakhs. This has to be converted into crores. So I have taken the same data as you can see here. So this data I have used for my calculation. This is for March 17 and March 18. The same way March 19 and March 20 we can get from annual report. This is the authentic data we can get. We can get these data in money control and screeners also, but it's better to take these data from annual report. That will be more authentic and our calculation will be more accurate. Here you have to check revenue from operations. It has given in lakhs, but we have to convert it into crores. That is 4115.29 crores. That point has to be shifted to 2 digits left. Then we will get the value in crores. So I have used this data and I have calculated the CAGR using the formula. The CAGR I got 16.3. So the revenue is growing at 16.3 year on year. Then I did a what if analysis or scenario analysis. Here we are expecting the revenue growth and we are estimating the revenue and estimating the market capitalization for actual CAGR and at 90% of CAGR, because markets will be fluctuation in nature. So I have taken the actual CAGR, then 90% of the actual CAGR. So we can estimate the revenue growth and revenue also using these figures. Estimated revenue will be the total income from revenue into estimated revenue growth plus 1. So this is the formula. Then estimated revenue for 90% of actual revenue is also calculated in the same formula. Then estimated market capitalization is multiplication of revenue multiple and estimated revenue. So we will get the estimated market capitalization. So I have calculated for actual revenue growth and 90% of actual growth. Then we can calculate the price per share, that is multiplication of market capitalization whole divided by total number of shares. This has to be converted back to the price in rupees. So here I have multiplied the total market capitalization value into 10 raised to 7. So that we will get the price in rupees. Then I have taken the average price per share because I considered 2 scenarios. So my total price is 597 in revenue multiple method. So now let us move on to calculate the value using EV by EBITDA method. For this we need again VWAP, then market cap and total number of shares we have already calculated. Then we have to calculate the debt. For this Borrowings figures we have to take, that is for current liabilities and non-current liabilities. This we can get in the annual report, or we can get in money control or screeners. So I got the total debt of 0.16 crores. So this is the total. Then we have to calculate the CC, cash and cash equivalents. So this is also we can get in annual report of any company. So CC is 15.9 and bank balance is 182.66 crores. The total will be 198.56 crores. My net debt will be the CCE minus debt, that is called net debt. Here net debt is in negative figures because my CCE is more than the debt. So it is always good for the company. So the figure is in negative. Then we can calculate the enterprise value. Enterprise value is the CCE plus market cap. This will become my enterprise value, that is EV. So this is EV, that is 6,847.23 crores. Then we have to calculate TTM EBITDA for last 4 quarters. This data we can get in money control. So here we have taken quarter on quarter results for calculating the TTM EBITDA. Here we have to take a depreciation and P&L before interest, exceptional items and tax. These data we have to get from money control or screener. I have taken from money control. Then all these 4 quarters I have added. So we'll get the TTM EBITDA of 470.53 crores. Then EV by TTM EBITDA is 14.55. This is the multiple, that is enterprise value divided by TTM EBITDA. So I got 14.55 as EV by EBITDA multiple. Then to estimate the EBITDA growth, we have to calculate the CAGR of EBITDA. For this we need PBT, that is profit before tax, then depreciation, interest or finance cost and other income figures. So these data we can get from annual report of the company. So these data will be easily available in the annual report. Then I have calculated the CAGR of EBITDA. We can get the EBITDA by adding profit before tax, depreciation and interest and subtracting the other income from these values. As you can see here, I got the EBITDA value for last 4 years, that is March 17, March 18 and March 19 and March 20. So this is the EBITDA CAGR calculation. So 11.2% is the growth of EBITDA. Then here also I have considered 4 scenarios, that is actual growth and 80% growth and 70%, 60%. Then I have estimated the growth of EBITDA. This will be the total TTM EBITDA into the CAGR plus 1. This is the calculation to estimate the EBITDA. Then expected EV can be calculated using the formula estimated EBITDA into EV by EBITDA multiple. So this is EV by EBITDA multiple. Then we can calculate the EV. After that, expected equity value can be calculated using the expected EV minus net debt. This is my expected equity value. After this, we can calculate the equity value per share. Here also we have to calculate the price in rupees. So 10⁻⁷ multiplication we have to do because the market cap is in crores. The formula is total equity value into 10⁻⁷ whole divided by total number of shares. We will get the value in rupees. Same formula is applied for 4 scenarios. Then I did average of these 4 scenarios. Then I got 560.76 rupees per share. Now I am going to calculate the share price using price to earning method. So here we need again TTM PAT. So we can calculate this TTM PAT using last 4 quarters data. Again I got it from money control. and got a 398.61 of TTM PAT, that is trailing 12 months PAT. Then I calculated the TTM PAT growth, that is CAGR. So for this I need last 4 quarters data, September 20, June 20, March 20 and December 19 data. So this is the CAGR. I got 19.46%. So PAT is growing at 19.46%. This is the compounded annual growth rate. Then we can calculate market cap. We have already this data, that is in crores, and PE of the company. This we can calculate using the formula market cap divided by the TTM PAT. So we'll get the revenue multiple. See here, market cap is 7046 divided by TTM PAT, that is 398.61. So I will get the price to earning ratio 17.68. Then I have the data of total number of shares. Now we have to get the peers data. So here I have taken 4 companies peers data of price to book value and price to earning ratios. These data we can get it from Screener's website. Then I did the average value of book value and price to earning ratios. Again I did the inward approach and peer approach, so that I will be more conservative than aggressive, because any company will grow according to its peers growth and its own growth. So we have to take into 2 considerations. So PAT growth I have considered 90% and 70% of the actual growth. Then estimated PAT will be 468.4 that we can calculate using the formula TTM PAT into 1 plus PAT growth. So I will get 468.4. The same formula is applied for scenario B, scenario C and scenario D. So expected market cap will be multiplication of estimated PAT into PE multiple of the company. See, this is estimated PAT and the PE multiple is, it is on the top. This is average value. So PE multiple, we have to multiply the market cap. So here this is PE multiple 17.6. So multiplication will be my expected market cap. So this formula is applied for other 3 scenarios. Here for peer comparison the value is different, because see, multiplication will be book value, we have to multiply with the expected market cap when I compare it to peers. So I will get different value. So then price per share will be expected market cap into 10 raised to 7 whole divided by total number of shares. So here we'll get the value in rupees. In the same way I have calculated the 4 scenarios. Then here I have given equal weightage to all these values, that is 0.3. Then all these weighted values are added to get the total price, that is 673.42. Let us calculate the value using book value method. Now I need the data of market cap, then VWAP, then current book value. These data can be obtained from Screeners, and we have already calculated some figures. If the current book value of the company is 119 rupees, and the price to book we can calculate using the formula VWAP divided by current book value. We will get the price to book multiple, that is 4.35. Then industry PB we have calculated in the previous method, that is 3.3. As you can see here, the last method we have taken the average value of 3 companies, that is the industry PB. Then I have taken the book value of 3 years back, that is 75.7. Then book value of 5 years back, that is 31. So these values are needed to calculate the growth rate of the company in book value. So I am calculating the 3 years growth rate and 5 years growth rate using the formula So when I compare to 3 years growth rate, it is 16.27%, and when I calculate the growth rate before 5 years data, that is 30.87. It's a very good growth rate. Then here also I did two approaches, that is inward and peer. Inward means inside the company how the book value is growing, and how the book value is growing when it is compared to its peers. Formula to calculate growth value is current book value divided by 3 years book value whole to the power of 1 by 3 minus 1. This is for 3 years. And for 5 years, current book value divided by book value before 5 years whole to the power of 1 by 5 minus 1. This is for 5 years book value growth rate. Then peer approach also did the same calculation. Then expected market price we can calculate using priced book value into the expected book value. You will get the market price. The same formula is applied here. Then I have given equal weightage here also, that is 0.3. Then we will get the weighted value is the multiplication of expected market price into weightage. So all these four values I have got by multiplying these two figures. So I am giving equal weightage to all these. Then we have to add all these weighted values to get the average market price per share, that is 674.57 rupees. Now let us calculate the final price. Here we got different values in different methods. So to get the final price, I have given equal weightage to all these methods, that is 25%. And see, this is the weightage, 25%, given the equal weightage to all. When I give weightage, I will be more conservative in the price, so it will not go aggressive. I am considering only 25%. So when I add these four values, I will get the total price of 626 rupees. This is my expected value by 1 year. So today 15th of Jan 21, I am making this video. So current market price is 505 rupees. When I compare this price, even if I take 5% less compared to actual value, I will get 595 rupees. So expected return will be 17.9% to 24.1%. This is a very good return, friends. If I get more than 15% is very good actually. But so many people will say 100% return, 200% return and all. Please don't believe. If you believe, you will definitely lose your money. 15 to 20% return is a very good return. So before buying any share, please calculate yourself and estimate the values in these simple methods. So retail investors like you and me, we have to be more careful while buying any share. So we have to have some idea of 1 year's growth at least. So here I am getting 17 to 24% of growth even if I invest at the current market price. Along these valuations, we have to check other parameters like ROCE, ROE and the company's fundamentals. What are the advantages? See, this company is almost debt free with good fundamentals. So friends, that's all for today. Happy value investing and thank you for watching. Please like, share and subscribe to my channel. Thank you and goodbye.